Well, welcome to the Mortgage Minute. My name is Jeff Harrison. I'm here along with
Art Alvarez, MortgageWorks.
Hey Art. Hey Art, welcome. How you doing?
Doing great. Jeff, how are you?
Good. Hey, this is our first show, or actually I should say not our, it's Art's first show. And I just want to introduce myself. I'm here just to basically work in the background. If you have questions or comments, because this is a live show, I'll be fielding the questions and comments and giving them to Art. And then if there's any technical issues, which we have to cross our fingers that doesn't happen, that I'll be here to take care of that as well. So keep in mind, this is a live interactive show. And Art, any other thoughts before I blink out of here?
No, thanks, Jeff. That's good. You'll be in the background helping us out as we get this first show kicked off.
Fantastic. Well, thank you. Let's have a great show. All right.
Thanks, Jeff. Well, hello, everyone. Art Alvarez at MortgageWorks, where we say we do have the answers and they're on the house. Just a comment, given our tagline, having the answers on the house, we spend a lot of time trying to provide good, concrete information to our customers and potential customers and provide the answers they need on any particular situation. And so part of the purpose of this show, this Mortgage Minute, is really to expand on that process and try to provide on a more constant schedule different information and aspects of the mortgage industry that you might find both interesting and helpful as you may perhaps be entering into a real estate transaction yourself or maybe a refinance of your home. So let me start off first with what's going on in the market this week, because it's actually a pretty interesting week. Because guess what? Not expected, but mortgage yields, bond yields have been dropping again. This is the second time this year that we've seen the 10-year bond yield, which I often talk about as your best benchmark for tracking mortgage rates. It's been dropping quite a bit. As of today, we were down under 3.3%. Well, not long ago, it was hovering around 4%. Well, of course, what that means is that mortgage rates, mortgage pricing, as I call it, has been trending in the same direction. So we're now back solidly in the mid to upper fives for conforming fixed rate loans. So what's going on here? Why is this happening? Well, it's having a lot to do now with a growing concern about recession. A couple of economic stats that came out this week were not particularly strong. Job growth is slowing. That came out this week, as well as manufacturing is down. And the bigger indication that we've got a pretty significant recession apparently in the works is what's called the yield curve, the inverted yield curve. What's going on right now is something that is a good sign of a pending recession. Short-term rates, such as a 3-year T-bond rate, T-bill rate, is 4.8%, whereas a 10-year bond, Treasury bond, again, as I mentioned earlier, is about 3.3%. So with that spread, 1.5% short-term rates being higher than long-term rates, that is a strong signal that a recession is coming. And what that tends to do in the mortgage industry is mortgage rates tend to fall in that situation. So I would be in the camp now to essentially predict that, yes, I think a recession is going to occur. I think it's pretty much already here or going to be officially here sooner than we think, certainly maybe by the end of this quarter going into the third quarter. So what that means for everyone in terms of trying to buy a home right now is it might be a very good time to get back out there active looking with rates back in the fives, and then with using some of the other features that we have like temporary buy downs, permanent rate buy downs. It's very possibly the case that you may be able to strike a deal to purchase a home with getting some interest rates, at least initially, maybe for the first 1, 2, 3 years, maybe in the 3s or 4s. So keep that in mind. The second time this year that we've had this kind of dip. And of course, what this is also suggesting now is that the Fed may decide to hold off. And now there's even talk that the Fed may reverse course and start dropping the Fed funds rate. Not sure I'd go that far, but it could happen. So keep that in mind. Rates are back down. Good opportunity to get out there if you haven't already. The other thing I want to mention in terms of what's going on in the mortgage business right now is And keep in mind, this is a California program. And as it relates to California, by the way, we're licensed in California. Though we're headquartered in Palm Springs, we can make loans anywhere in the state of California. So keep that in mind. And we do that all the time. But the state of California, specifically an agency known as, we call it CalHFA, that stands for California Housing Finance Agency. Now, this agency has been around for decades. It provides mortgage money for first-time home buyers, typically programs that have income limitations, sometimes not so often too much anymore. Used to have sale price limitations. And then, of course, you typically have to be a first-time home buyer, which, by the way, what is a first-time home buyer? Well, in the mortgage industry, the definition is you haven't owned a home as your primary residence in the past 3 years. So if you haven't owned a home that you lived in as your primary residence for the last 3 years, you're considered a first-time home buyer for this type of program. Well, CalHFA announced just last week a new program called the California Dream for All Shared Appreciation Program. Now, what does this mean? Well, this program offers down payment assistance up to 20% of your purchase price. Well, that's substantial. So what would that mean? Let me give you an example. You're looking at a home for $500,000. In this case, you would get a loan amount of $400,000, and then you would get down payment. And you're financing the $400,000. That's a great opportunity because essentially you're qualifying on just the first mortgage amount, and you don't have to bring up that cash to close.
Art?
Yes.
I'm sorry. Just as you were starting to give us the punchline, the most important part about this California Dream for All Appreciation Program, we had a little hitch in your get along. We lost transmission. Can you start out at the top with that again, please?
Oh, okay, sure.
Thanks.
Yeah, as I was mentioning, with this program, the main feature of it is it provides down payment assistance up to 20% of the purchase price of the home. So as I was explaining, if you buy a home for $500,000, you can get a down payment assistance of 20%, $100,000. That would serve as your down payment, and then you would finance or get a first mortgage for $100,000 or for $400,000 to total the total of $500,000. Now, you do have to be a first-time home buyer to be eligible for this down payment assistance, and you have to have income within the maximum income limits as published by the agency. And those limits, by the way, are quite high, actually, quite generous. So most families, I think, would be eligible for both the income limits and, of course, if you're a first-time home buyer. Now, this money is not free money. It's not a grant. It's not something that you just get and you don't have to worry about paying back. It is a lien. It is a junior mortgage lien, but payments on it are deferred. And so how do you pay it back? Well, later on, when you sell your home, that is when you would pay back that initial 20%. In the example I used, a $500,000 purchase price. That's when you would return the $100,000 down payment assistance that you got, as well as you do have to give the agency 20% of your appreciation since you first purchased the home. Not equity, appreciation. Let me give you an example. You bought your home for $500,000, as I've been saying. 8 years later, you sell it for $800,000. You had used the California Dream for All and gotten $100,000 down payment assistance when you bought your home for $500,000. 8 years later, when you sell it for $800,000, you have to pay back that $100,000 from your proceeds, and you have to pay back 20% of the $300,000 increase from the $500,000 purchase price that you had to the $800,000 sale price when you sold the home. So that's how it works. So this is a great opportunity for those buyers, first-time home buyers, who have been challenged with down payment. It's a great opportunity to really be able to get helpful assistance with the down payment. And we think, and we're already seeing evidence, it's going to spur, I think, a lot more purchase transactions here in the near future. So keep that in mind. Anyone you know who's a first-time home buyer should definitely be aware of this program. And feel free to call me or email me or send me a text. I'll be happy to provide you more information.
All right, we have a couple of questions before we move on. One is, can you clearly define what first-time home buyer means? Is that like you've never bought a home, or is it a period between you bought a home and now you haven't bought a home? And then also, with this assistance as a down payment, because it's up to 20%, can that effectively, especially with the rates the way they are, I know they're going down. The question is, will we see our payments go down? Because I think you said that was deferred, correct?
Correct. Well, let me answer the first question first, which is the first-time home buyer. Now, yeah, that's a very good question, because in the mortgage industry, there's a specific definition that may not seem as obvious to a consumer as you might think. In the mortgage industry, well, for example, for the California Housing Finance Agency first-time home buyer programs, their definition of a first-time home buyer is someone who has not owned a home that they lived in as their primary residence for the last 3 years. So that actually means that you could have somebody who's been renting at their primary residence for many years, and maybe they own a rental property in another state. Well, for a California Housing Finance Agency program, they would be considered a first-time home buyer. Now, with respect to how you're qualified, that down payment assistance of 20%, the payments are deferred. And so that portion of the purchase, that $100,000 down payment assistance out of the total $500,000 purchase price example I've been using, that's not taken into account in calculating your debt ratio. So the benefit of the program is, instead of getting a first mortgage that might be at 97 or 95 or 90% of your purchase price, it's at 80%. So of course, just by nature of that, you're going to have a lower monthly payment. Plus the fact that because that 80% first mortgage is at 80%, there's no private mortgage insurance coverage. So you don't have that expense. So this program gives some specific help to the home buyer, the borrower, in terms of lower monthly payments by way of the structure of the 20% down payment assistance and the lower loan amount that results that doesn't require mortgage insurance. So hopefully that would answer the question, I hope.
I think that's good. That helps answer it. Obviously, if you have 20% down versus a 3 or 5% down, that's going to lower the payment. The one question that they said is, just to clarify, the 20% that is at down payment assistance, there's no payments made against that. That's set
Correct.
aside until the end, correct?
Correct. And that's the whole reason for the sharing of your appreciation in the future. So it's one of those situations where when you get the down payment assistance, there's no payment on that piece, that 20% piece. But where's the catch up? How does the agency, essentially catch up on that lost, a return? Well, from the shared appreciation. When they ask for and get 20% of your appreciation when you sell the home many years later, that essentially accounts for having those payments deferred initially.
Art, this still seems like such a great opportunity for someone out there to buy a home, even in today's market. Two questions. One is, how can people find out more about that? Like, how can they get in touch with you? And then second, is this driven because of the inflation and the high rates that these lenders, and really in this case, California, is getting creative to try to help people buy homes and realize their dreams?
Yes, exactly. Well, first of all, in terms of how to get a hold of us, how to get a hold of me, it's pretty simple. I'm available anytime, the usual day or night, 24/7. Of course, there's the office number. We're in Palm Springs, 760-883-5700. My cell phone, which of course is where most folks tend to call me, 714-612-9035. And so you can call my cell or send me a text. And then, of course, my email, very simple, art@mwloan.com. And then, Jeff, in terms of this program, yes. Now, keep in mind that this particular, I call it an agency program because it's coming from the California Housing Finance Agency. That's who has developed the program. So it's not really developed by lenders. The lenders are essentially the delivery vehicle to prospective home buyers and borrowers to provide them this kind of financing. But this is definitely right in sort of the wheelhouse of the core mission of the California Housing Finance Agency, which is to spur more home ownership, more home purchases by first-time home buyers, because they remain, particularly at this current situation of very high rates, still elevated property levels. First-time home buyers still remain probably the most underserved part of the mortgage and real estate market. And this is definitely a program targeted directly to solve that problem. And I think it's going to make a big difference. Just in sharing this program with realtors that I do business with, I've already had at least one say she's already gotten an offer on one of her listings where the financing is going to feature this program. So I think it's going to be very popular, and I would urge people to, if you're on the fence about buying a home, you're a first-time home buyer, get in the game and check this out. I think it's worth looking at.
Before you go to the next topic, I'm just curious about one thing. Is, are there seasons in the housing industry, like where it's busier than other times? I mean, I think here in the Coachella Valley in Southern California, I mean, the weather's perfect all the time, typically. But are there seasonalities to your business? And is it the timing seems to be potentially perfect for this program?
Well, yes and no. I think the timing is good for this program, given that it's come out, in the springtime, although we're starting to get a little bit later in spring, but we still got plenty of time for people who are motivated by trying to find a home before the school year starts in the fall and that sort of thinking. This is good timing for this kind of program to hit the market. For the decades I've been doing this, and of course, it's always been sort of the, prevailing wisdom that real estate is a cyclical business, not just in terms of rates and home prices, but also in terms of seasonality. Like, for example, here in the Coachella Valley, there's always the belief that, in the off season, which of course here is in the summertime when it gets extremely hot, that is when, activity slows down. But, my personal observation, and I've been in a lot of different markets, including not just California, but Nevada, Arizona, Washington, Oregon, et cetera. I think that's a little bit overdone. I know, in fact, I think Palm Springs Life, the publication here a few years ago, 5-6 years ago, I think they did a study of real estate sales in the Coachella Valley, here in the Palm Springs area, and compared it, throughout the year. And what they found was the ratio of activity was almost the same. It was literally like 51, 52% during the season, defined as going into, after the holidays into the spring and early summer. And then the off season was like 48, 49%. So it was actually very well balanced between the supposed in season where it's cooler, as well as all of our snowbirds, which of course affect our market here. And then that very hot summers where supposedly everybody's cloistered in their homes and not looking to buy homes and so forth. So the data just didn't support the notion as much as everyone thought. So anyway, we'll see.
There's one follow-up question on this this program, the California Dream program. Mm-hmm. The question is, well, what happens, Art, if my home doesn't go up in value? Now, I know that's a hard one to stomach because real estate forever has gone up. But what happens if that occurs? Is that homeowner on the hook for that loss of 20%?
Excellent question. And that's part of, and to the extent I'm able and I'm starting to talk to prospective buyers about this program, that you're hitting on a very important topic that needs to be understood. Because again, while these can sound just too good to be true almost on their face, you have to understand there are some risks. Now, some people just flat out would say, well, I'm just not interested in giving up any of my appreciation in the future just in return for this benefit. Okay, understood. That's fine. If you have a way to otherwise accomplish your goals in terms of home ownership without this, then that's great. Now, for those who need this, understand there is some risk. And the primary risk is, just as you mentioned, what if your home doesn't appreciate in value, or God forbid, and of course it's happened before, we hope it's not going to happen again, certainly not to the level we saw 15 years ago, but what if your property value falls? That doesn't relieve you of paying back that 20% assistance. So in a scenario where in the later years you sell your home, and maybe you have to sell your home, and the value has actually fallen and not gone up or just stayed the same, you do still have to pay back that down payment assistance. And in an extreme scenario, you could be faced with, of course, in selling your home, maybe having to do it with the old short sale process that we all became familiar with, again, after the Great Recession in 2008. So yeah, it does have to be paid back. It's not free money. And so you are hitting on, that is probably the biggest risk to the program.
Well, Art, this is I think what you're doing and providing this type of asset for people who are thinking about getting in, buying a home. They maybe, let's talk a little bit about what other services you offer besides just, hey, I'm buying a home and I need a loan. What other services do you offer at MortgageWorks that, let's face it, we're homeowners and we need some help with things?
Well, there's a couple things, and this applies both to prospective home buyers as well as homeowners. On the home buyer side, I mean, certainly, obviously, our what we do every day is to help home buyers finance the purchase of a home, and of course, we're always trying to find opportunities to help both new customers and our past clients when they have a scenario where they're buying another home. But in addition, particularly with real estate agents I work with, I try to encourage them that I'm happy to meet with someone who's maybe not where they need to be to buy, but want to essentially get some assistance as to what direction to go, what to focus on in getting themselves to a position to buy. A couple of my agents will refer to as, giving them a pathway to home ownership. That's something we do, and we are happy to do it. We don't charge for it. I mean, what we're hoping to do is take someone who maybe isn't quite where they need to be to qualify to buy a home and put them on a path to get to where they can and give them some advice and direction as to how to do that. So that is something, and that can mean, by the way, I've got files in my drawer here that are 6, 8, 10 months old, where we've helped people in that situation and with that kind of a process. For our existing, borrowers who own homes, right now it's all about trying to keep everybody aware of the fact that with, the higher rates that we have, and with the fact that most homeowners have rates on their first mortgage that are extremely low, majority, over 80%, probably under 3.5%, that increased equity that you have, we can help. We have programs to help you tap into that equity, whether it's your primary home, your second home, even your rental property, whether it's equity loans, fixed rate second mortgages, or of course the very popular home equity lines of credit. That's something we try to keep our customers aware of. That's something that we definitely do. We're doing a lot of them, and it's a great way for homeowners to be able to tap into that equity for any purpose they need the money for. So those are just a couple of ways we try to help both our current customers as well as new home buyers.
Art, I'm curious with this push in California, with going solar, going with be more energy efficient. Is this a possibility of someone saying, hey, I've got all this equity in my home. Should I take it out and use it as a way to buy or fund that solar to put on my house? Is that something you do, or should they just stay with maybe and I know every situation is different, but should they just stay with the lenders that are offering that from the solar companies?
No, actually, I think an equity loan, in particular a home equity line of credit, I would argue is an excellent alternative to using the financing that is presented to a homeowner through a solar company. My understanding of those sorts of solar loans is that they typically will have a 20-year term. Interest rate's going to be up there. My understanding is they're essentially hovering around double digits, 10% or so, 10, 11%. And that many of them actually are structured to where you're required to pay as much as 30% of the loan balance within the first 18 months, or the interest rate on the loan escalates. And then some of those loans also are structured to be paid back through your property taxes. So you end up, at least for the life of that loan, you're having a substantially higher property tax that you're paying, and that portion that's covering the solar loan does have an interest rate on it that's similar to what I just mentioned. So as a consequence, I think a HELOC is a great alternative for a couple of reasons. One is, in terms of rate, HELOCs used to provide a better rate advantage. That's less so now because of the Fed's action in raising the Fed funds rate. What we call the Wall Street Journal prime rate right now is at 8%, and most HELOCs have margins of 1 or 2% above that. So a HELOC loan for a good borrower, good equity, is probably hovering close to 9 or 10%. So maybe you could argue similar to a solar loan. However, with a HELOC, you've got more flexibility and more payment options. For example, your monthly payment option minimum is interest only, although I argue you should try to pay more to keep that balance down. And that's where your other benefit is with a HELOC. Let's say you need 50 grand to put in that solar system. Well, instead of getting that solar loan 20-year fixed at 11%, get a HELOC at 50,000. Use that to pay off, to pay for the solar installation on your home. And then as you pay down that HELOC, creating unused credit between that limit of 50,000 that you first got and what you've paid it down to, that's reusable. For the first 10 years, any unused portion of your credit limit you can use again, just like a credit card. In fact, that's what I typically tell homeowners is think of a HELOC as a credit card secured by your house, because a HELOC, by the way, is a second mortgage. I've had some people say, no, I don't want a second mortgage, I want a HELOC. Well, a HELOC is a second mortgage. It is secured on your home as a junior lien behind your first mortgage. And because of that flexibility, because the rate's comparable, and because of the fact that later on when you do pay off that HELOC, if you've done so within that first 10 years, you can use it again for almost any reason. So I think that gives the edge to a HELOC as, I think, the best way to finance a solar system.
Art, this is, as I say, this is great information. Give us an idea, give us an outlook of what someone can expect if they're just tuning in or they watch this. What kind of things are you going to talk about in the future? Because this is going to be on, as I understand it, every Thursday from 2 to 2:30, roughly. And you're going to talk about all kinds of things. Kind of give us an idea, a preview, if you will, of the future.
Sure. I mean, there's all sorts of things that we'll be covering in this Mortgage Minute. I mean, it's going to run the gamut. I mean, there's so much that's going on in this industry, a lot to keep track of, and a lot of it is good information that I think the general public would find helpful and useful to be aware of, whether you're a homeowner or looking to buy a home. And we're going to cover things like different loan programs hitting the market, like we're talking about today with the California Dream for All program. In the future, for example, I'll be talking about jumbo loans, getting into non-QM products. Those are the low doc kind of alternative lending products that we are using today. So we'll talk a lot about loan products. In some installments of this show, we're going to be talking about different underwriting guidelines that can affect people both positively and sometimes negatively. We're going to be talking about what's going on with the federal mortgage agencies, FHA, VA, Freddie Mac, Fannie Mae, as well as what's going on in the real estate industry in general in terms of, sales activity and home values and so forth. And of course, a lot of what we'll talk about is just keeping track on what's the economy doing, how's that affecting the bond market and therefore mortgage rates, and keep you abreast of that, because I think that's just something to keep an eye on all the time. So we'll have a lot to cover.
Well, I'm looking forward to it. Hey, I want to share your screen. It is your website. Tell us what we're looking at here so people are aware this is MortgageWorks.com or MWLoan.com.
That is correct. This is the homepage for our website. And on the homepage, you can see we have a rate grid. What I call this is our rate indications, because, of course, the specific interest rate that a borrower can get is going to be subject to a lot of different characteristics that we have to verify first. So this gives you an indication of where the market is at any given time. So feel free to use this as a simple tool. In addition to checking the 10-year bond yield, maybe you can jump on our site and get an idea where mortgages are right now in terms of rate, not just conventional loans, but jumbos, FHA, VA, USDA, and we also have second mortgages, although the grid's not big enough to include that on the grid. And on our on our website, we have other features like calculators. Be sure to check out our blog section. Lots of information about different loan programs. And we even have an article that we wrote way back when we started that gives you a better idea of how we are philosophically as a company in serving our customers. And you can reach this again, like you said, at MWLoan.com.
Fantastic. Well, I'm going to put your information up there as far as how people can get in touch with you. Again, it's art@mwloan.com for an email, or 760-883-5700, and that's into your office. I was going to put your cell phone up there. It went 114. What is that again?
Yeah, cell phone number 714-612-9035. So you can use that anytime for a call or a text, and it can be after hours and weekends. That is fine. Feel free to call.
Fantastic. Well, Art, thank you so much for doing this. We're right at the bottom of the hour, and you were very efficient with your time and generous with your information. So thank you so much. For those of you watching it recorded, please put any of your comments in the comments section, and Art or I will get them to Art, and we'll get you an answer, or we'll answer it on the next show. Art, thank you so much for being here. I really appreciate it.
Jeff, thank you. Appreciate the opportunity. And just remember, at MortgageWorks, we have the answers and they're on the house.
Fantastic. Thank you, guys. We'll see you next week.
Thanks. Take care.